Plug Power and ChargePoint are trying to benefit and trying to help the world transfer into more sustainable energy. Unfortunately, things have not gone according to plan for either of these two companies, and their growth rates have slowed down and the losses on the bottom line are mounting. But if you had to pick one of these two, and you were bullish on the future of sustainable energy, which one of these two stocks would you buy? That's the question I'm going to answer in this video. Comparing these two on revenue, on profit, on cash flow, return on invested capital, and valuation to determine which one of these two companies is a better buy for long-term investors. Let's take a look. I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. So as you'll notice here, Plug Power and ChargePoint had been growing revenue all the way up until maybe 2023. And then you started to notice that decline here in revenue for each of these two companies. The main reason for that decline in revenue is because of the higher cost of capital. I highlighted that these two are losing massive sums of money on the bottom line, and I'll share with you exactly how much. And so they needed money from investors to continue growing revenue because they were taking investor money and building the business while accepting losses on the bottom line. But when investors started asking for more money in return for giving them money or more interest expense in return for giving them money, these two companies said, all right, then that doesn't make sense for us to continue looking for this kind of growth if it's going to cost us 15% interest on those funds or 15% cost of equity or 15% cost of capital on the money. So it might make more sense for us to slow down our growth ambitions and try and improve our unit economics and try and reduce these losses on the bottom line, which is what each of these two have done in recent quarters. Comparing the two on operating losses, we see a similar story. And for Plug Power, it's much worse. You can see the operating margin on a trailing 12-month basis, negative 163%. And over the years, it's moving in the wrong direction. You've seen me cover over 100 companies, and many of them have losses on the bottom line. But many of them that are losing money on the bottom line are improving. They're reducing the losses on the bottom line. As they're growing revenue, their unit economics are improving and the business is approaching profitability. That hasn't been the case for Plug Power or ChargePoint. As they've grown revenue, they haven't made sufficient progress in improving the operating margins. They've just lost more and more and more money as they grow the business. And so you're not seeing evidence of economies in scale. You're not seeing evidence of learning curve improvement, where as a business, the more you do the same activity, the better you get at that activity, the lower your costs are for each value activity, and thereby your profit margins improve. You haven't seen that very much, especially not with Plug Power. Maybe you can argue a little bit with ChargePoint, but not very much. You could see negative 85% operating margin, and it's actually down. It was improving from January of 22 all the way to, I would say, mid 2023. And then you saw the margins again worsen for ChargePoint. So very little progress for either of these two innovative companies. And it's a similar story for if you compare cash flow from operations to sales. Some companies with massive losses on the bottom line might still be cash flow positive because they're using a lot of stock-based compensation. And so even though they're losing money on the bottom line, they're still positive cash flow, which is a sustainable model. You can continue that way because you're still building your cash. You're not losing cash, and therefore you don't need to go back to investors for more money. You don't run out of money if your cash flow is positive. Even if you're losing money on the bottom line on a net income basis, if you're positive on a cash flow basis, your business is still sustainable. That's not the case for these companies either. And again, for Plug Power at least, it's moving in the wrong direction. Negative 127%, and that's down from negative 75%. So its business is just getting worse. The unit economics are getting worse. little improvement. And this has been the story with Plug Power. Hopefully you've avoided this stock. I've had Plug Power stock rated as a sell, and I've been telling investors to avoid this company for several years now. And you can see why I've been saying that. Same thing with ChargePoint, negative 57%, very little improvement over the last few years. And I don't expect these conditions to improve for either of these two companies. ChargePoint was, and the EV industry overall was forecasting that by this point, there would be many more electric vehicles on the road, and therefore the demand for charging those electric vehicles would be much higher. But that hasn't been the case, and nearly every EV company outside of China has been adjusting to the reality that EV sales are not going to be as great as was expected unless there's some kind of miracle technology over the next couple of years that changes the economics of charging. You've got to get charging time down closer to the time it takes you to fill up gas. Or you've got to get charging technology available to all households, not just homeowners, right? If it's charging is available overnight to everyone living in an apartment and not just people living in their own homes, then that would make more sense for a lot more people worldwide. As it is now, it just doesn't make sense for many, many people around the world. And so that's not increasing as much. And then with Plug Power, the hydrogen fuel, it makes sense for a few businesses, but the growth has not been there, even at these very low prices that Plug Power is selling the technology, selling this energy. Because even at those prices, look how much money Plug Power is losing. Imagine if they had to, imagine if they lift prices to a level where the business is sustainable, how much more revenues would decline. So they've got to, and they're working on it. They're working on improving their manufacturing capacity because if they can generate more fuel themselves, they think they can lower the cost of the fuel and then they can generate better margins when they sell that to other companies. And finally, let's look at the valuation. Plug Power stock is trading at a forward price to sales of 2.27, almost double the price of ChargePoint at 1.188. And ChargePoint is the much cheaper stock. Now, I would not want to own either of these two companies. In fact, let me share with you. So Plug Power and ChargePoint, I have rated as a sell. Each of them, I have them rated as a sell. I cover over 100 companies, and I think I have less than 10 of them rated as a sell. And Plug Power and ChargePoint are the two that I've had rated as a sell. I've had them rated as a sell all year in 2024, all year in 2023, all year in 2022. And you get the point. I've had them rated as a sell for as long as I've been covering them, and it's been several years that I've been covering these two companies. So if you forced me to buy one of them, or if you're adamant in buying one of them, I would go with the lower priced option, ChargePoint, at the forward price to sales of 1.188. Also, ChargePoint, its margins and cash flows are better than Plug Power. At least they're not going worse. So that would be my choice. Again, I don't like either of these two companies. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.